Welcome to the Deep Dive. Our mission is simple. We transform dense, complex corporate disclosures into the sharp, essential insights you need, and we do it fast. Today, we're diving into the Core & Main fiscal Q3 2025 earnings call. Now, this is the leading specialty distributor for North American water infrastructure. It's a critical sector, but also a really complex one.
That's right. And for Core & Main, the whole story coming into this was about resilience. They're diversified across municipal, non-residential, and residential markets. But with construction being so choppy, the market was nervous about volume. Our job today is to figure out what they did to deliver such a knockout performance where it really mattered.
Okay, let's unpack this then, because the headline numbers, they look kind of muted at first glance. We saw marginal growth on the top line, which doesn't usually send a stock soaring.
Precisely, yeah. If you look at the results snapshot, net sales landed at $2.062 billion. That's a modest 1.2% increase year over year.
So barely beating consensus.
Barely. And that's why this isn't a revenue story. The sales figures are probably the least interesting part of the whole thing.
So the excitement must have been purely on the bottom line then. Where was the shock and awe?
It was entirely on profitability and execution. So GAAP diluted EPS was a solid 72 cents, right in line with expectations. But the adjusted diluted EPS, that's where the magic happened. They delivered 89 cents.
89 cents. And the street was at what?
The consensus was around 71 cents. So that is a whopping 26% surprise beat on the bottom line.
A 26% beat is massive, especially for a mature infrastructure distributor like this.
It really is. And on top of that, adjusted EBITDA came in at $274 million. Even though that was a slight dip from last year, it still meant a strong 13.3% margin. Again, slightly beating consensus.
So the market saw this and just said, okay, we don't care about volume.
Exactly. The narrative became, this is a textbook execution and efficiency story. They're delivering profitability in spite of a tough macro environment.
That margin resilience is the key insight. What's so fascinating is how they did it. Because, 1% sales growth doesn't naturally lead to higher profits.
That is the critical deep dive question, isn't it? Gross profit actually grew much faster than sales, up 3.3% year over year. And that pushed the gross margin up by 60 basis points to an impressive 27.2%.
60 basis points in one quarter with volumes flat. I mean, what levers are they pulling to make that happen?
It's sort of a triple threat. You've got disciplined sourcing, excellent pricing in key categories, and a really favorable product mix shift toward their higher margin stuff. But if you want the biggest, most structural driver, you have to look at their private label initiative.
Right. We talk about private label being a long-term tailwind for distributors, but 60 basis points in one quarter, that seems like a lot to pin on a program that's still pretty small.
You're right to question the scale. Private label products are currently sitting at just 5% of total sales. However, the long-term target is substantially higher, somewhere between 10% and 15%. And management is confident this alone can structurally drive 10 to 20 basis points of margin expansion every single year.
Wow. Okay. So it's a compounding story. What's small today becomes a huge structural advantage over the next decade.
That's exactly what sophisticated investors want to see.
And that structural tailwind is crucial, especially because they face some serious cost pressure in SG&A this quarter. Expenses were up 8% year over year. What was driving that?
A few factors. They had costs from recent acquisitions, continued investments in tech and expansion, and a notable spike in cost inflation. Specifically, they called out facilities, fleet, and medical costs, which were seeing mid-single-digit inflation, much higher than the low single digits they usually plan for.
So they were getting squeezed.
Yeah.
Their response then had to be immediate and pretty surgical on cost control.
Absolutely. They implemented about $30 million in annualized cost savings. This involved eliminating about 4% of non-sales focused roles since the last quarter. And what's important here is they're investing in frontline sales while getting lean in the back office. They're optimizing that operating leverage.
But if they cut $30 million in cost, how much of that actually helped Q3 deliver that massive EPS beat?
A tiny fraction, actually. They only recognized about $1 million of those savings in Q3. The real impact is forward-looking. Management guided that Q4 SG&A should be about $25 million lower sequentially, but the full $30 million benefit is really a story for fiscal 26.
So the market isn't rewarding them for savings they book now, but for the promise of future efficiency. It's a huge bet on operating leverage down the line.
It is a massive vote of confidence. And they have the cash generation to fund this whole transformation. The cash machine is it's running smoothly. Net cash from ops was $271 million in Q3 alone.
And I remember you pointing out that their free cash flow yield compared to their peers is almost unbelievable.
It's a powerful signal. Their FCF yield is sitting around 5.6%. That is more than double their specialty distribution peers, who are around 3.4%, and it just dwarfs the S&P 500 average.
And they are using that war chest aggressively on capital returns.
Oh, they are leaning in hard. They repurchased $50 million worth of shares, about 1 million shares, in Q3. But the crucial market-moving signal was the board's announcement. They expanded the share repurchase authorization by an enormous $500 million.
Bringing the total capacity to what?
A staggering $1 billion.
That's basically telling the market, we think our own stock is the best investment we can make.
Exactly. They're actively consuming their own equity, which boosts EPS and shows huge confidence. And, it also provides a protective floor under the stock price.
Okay, so given management proved they can execute internally, let's turn to the end markets. What are the underlying infrastructure volumes actually telling us? Are things getting better?
Management is still framing overall end market volumes as flat to slightly down. So again, they are succeeding despite the market, not because of it.
So where does the resilience come from if overall volume is flat? Is it the municipal side holding them up?
It is. That's the foundation of their business. The municipal and non-residential segments, which are a dominant 80% of their sales, demand there is exceptionally robust.
And that's because the funding is reliable.
Yeah.
It's not discretionary.
Absolutely. The funding is supported by local utility rates, state funds, and critically, that federal IIJA funding the Infrastructure Investment and Jobs Act. These projects, repairing leaky pipes, replacing old systems, they're long cycle and they're essential. You can't just defer them forever. They cite examples like Texas authorizing up to $20 billion for water projects and New York deploying about $3 billion. This is structural, secular demand.
And within those strong muni markets, they're finding these high-value niches. Tell me more about those specialized products driving the margin gain.
Yeah, management highlighted high single-digit or even double-digit growth in these categories. Things like fusible HDPE, which is a specialized piping, and geosynthetics, which are these high-tech fabrics for soil stabilization. They also saw big growth in treatment plant solutions and metering products, where they actually secured their largest metering contract award to date. They're just focusing where the margin is highest.
We also heard them talk about an interesting tailwind, the rise of data centers. How does a company that sells pipes profit from data centers?
It's a surprising but pretty significant link. Data centers are a low single-digit part of their sales now, but growth is accelerating fast. Because AI requires massive amounts of cooling, it puts this huge sustained strain on local municipal water systems.
So it's forcing immediate and substantial infrastructure upgrades.
Huge upgrades, new supply lines, on-site water treatment. It's forcing towns to upgrade systems that haven't been touched in 50 years.
That must create pockets of intense demand.
Exactly. They give this great anecdote about a hyperscale campus near South Bend, Indiana, and said the local core and main branch has nearly tripled in size just from that one customer segment. It's a massive, non-cyclical growth driver.
Okay, let's touch on the soft spot. What did management say about residential, which is less than 20% of their sales?
Residential, which is tied to new lot development, softened as expected. They saw declines, particularly in the Sunbelt, Florida, Texas, Arizona, Georgia. But management did note the decline stabilized late in the quarter, and it performed in line with their cautious expectations. They see it as pent-up demand that has to be released eventually.
And they're still expanding aggressively through M&A and new locations, right?
They are actively taking market share. 5 new greenfield locations year to date, including in Houston and Denver, with more planned. And M&A is still a high priority. Look at the recent acquisition of Canada Waterworks, which gets them into the fragmented $5 billion Canadian market.
So, okay, given this incredible performance on margins and cash flow, why did they just reaffirm full-year guidance instead of raising it?
That is the most critical question coming out of the call. Management reaffirmed the guide. Net sales still at $7.6 to $7.7 billion, and adjusted EBITDA at $920 to $940 million.
So after that huge Q3 beat, shouldn't that naturally translate to a guidance raise for the year?
Their cautious outlook is, I think, very intentional and strategic.
Yeah.
They're telling the market their outperformance is driven by their internal execution, so above market growth and margin control. They are not raising the guide based on a change in their cautious market outlook, which they still see as flat to slightly down. They are guiding to what they control, which forces the street to focus on their execution.
And what about pricing? We know PVC pipe pricing has been all over the place.
Still volatile, but they're managing it. Overall pricing is expected to be neutral for the full year. That means prices are actually up for most products, but it's being offset by that continued drop in municipal PVC pipe pricing. For FY26, they expect pricing to be at least flattish.
So the strong price reaction from the market, that 5 to 9% pop, it shows investors are totally comfortable with that balanced view. They're prioritizing durable execution over chasing volume.
That is the takeaway. The street sees them as a premier, stable infrastructure platform. When you combine that margin story with the exceptional cash flow and that massive buyback, investors are going to prioritize that over a flat volume outlook every time.
This is not financial advice segment.
All right, so this earnings call gives us a perfect setup for a trade idea that really capitalizes on that balance sheet firepower. The question is, how do you play this strength in capital returns when the market is still hedging against that residential softness, which could cause some volatility?
You need a strategy that benefits from the stability but still offers some protection.
Right, exactly. So we're calling this one the structural floor trade. The thesis rests entirely on two things: that superior 5.0% free cash flow yield and the colossal $1 billion share repurchase authorization. That buyback is like an active defense system. It provides a structural floor under the stock, regardless of those near-term macro headwinds.
Okay, so how do you structure a trade to monetize that downside protection?
You buy the C&M equity outright to capture the EPS boost, but you simultaneously hedge by selling cash-secured put options far out of the money. So you're targeting a strike price maybe 10 to 15% below the current level with an expiration 6 to 9 months out.
So you're collecting premium by betting the buyback will prevent a sharp drop.
Precisely. You're getting on that active defense. And then factor number two, if the stock does fall to that level because of some macro shock, you're perfectly willing to put the stock at that much lower price. You effectively lock in the chance to buy a proven cash flow compounder at a big discount, knowing the buyback program is still active and working to raise the floor beneath you. It's a bet on the balance sheet's firepower.
That was a tremendous deep dive into an infrastructure story where, execution and financial discipline clearly just outweighed all the macro noise. The major takeaways are absolutely clear. A huge 26% bottom line beat, 60 basis points of gross margin expansion from things like a private label, and that massive $1 billion buyback.
And here's a final provocative thought for you to chew on. Management implemented $30 million in SG&A savings, while at the same time investing heavily in new tech, acquisitions, and new branches. This signals a relentless focus on regaining operating leverage. So, considering most of those savings really hit in FY26, what level of long-term SG&A efficiency is actually achievable when you pair it with the structural benefits of that 10-15% private label target? That compounding effect efficiency plus structural margin, that's the next big leap investors should be watching for.
Thank you for joining us for this deep dive. We appreciate you trusting us to synthesize this complex information and provide the essential insights you need to stay well informed.